Good morning, everyone. Welcome to Decipher with Deserves webinar series. First of all, thank you for taking out the time to join us on a Saturday morning. We hope we do justice to the time you've allocated to us, and we hope you take back some learnings from today's session. We have an excellent panel for you this Saturday. We have Mr. Gaurav Misra. He's head of equities at Mire Asset Investment Managers. Mr. Misra has over 28 years of experience in investment management and equity research functions. Prior to joining Mire Asset, he was associated with ASK Investment Managers for 14 years. Mr. Gaurav is an MBA from IIM Lucknow and a bachelor's in economics honors from St. Stephen's, Delhi. With him today, we have Vaibhav. Vaibhav is the co-founder at Deserve and overlooks active management of over 16,000 crore of client assets at Deserve. He brings over 20 years of wealth management expertise. In his previous role, he managed over 22,000 crores in assets and advised more than 500 affluent families in India. He actively contributes to the investment committees of several prominent family offices in India. So, folks, one of the key themes of this webinar today is to separate the wheat from the chaff, right? In other words, we want to separate facts from narratives. Too often, investors take decisions based on headlines and narratives. Today, we want to look at some of those headlines and help you relook at them with data and facts, right? So, with that, let's start. Uh, Donald Trump issues World War III warning. This was the headline on Newsweek magazine on 12th of December 2025, right? Gaurav, we'll start with you. What do you make of this headline and what is the data telling us?
Well, I mean, to put it in context, all these the news has to be looked at in context. So in this case, by that time frame, towards the end of last year, Donald Trump's proclivities were well known, and so this was just one of the usual sort of news coming out. Having said that, with the U.S. It is evident that for the past sometime the U.S. economy itself has become a bit, polarized. And over the last 2-3 decades, there has been this big chunk of the population in the heartland of U.S. which has been left behind. And if you think of how the income sort of distribution is, so the U.S. is a much more, has a highly skewed income distribution, more towards the rich, versus say Europe, which is a bit more egalitarian, and a lot of and versus most other developed countries for sure. US is much more skewed. The rich are really rich, and there's a big sort of class which has been left. So the point I make is that when you have in the background something like that, that's a fact that doesn't change overnight. Politicians of this type, whether it's him or someone else, are likely to emerge and continue emerging. So you have to look at it, with both the things. But in this case, these kind of dire sort of news bites is clearly, I would be ignoring it whenever it came.
Thank you. Vaibhav, what do you think of this? Can we apply the taco, which is Trump always, chickens out, investment strategies? This, kind of like a parallel from that. What do you think?
Good afternoon, everyone, and thanks for joining in. Yash, my view is very clear that he's going to chicken out again, and we are seeing early evidences of that. Uh, Last week he was talking about all the options were there on table around Greenland. Now is completely denied any aggression on Greenland and is looking for more diplomatic solutions around that. So obviously he will always chicken out. Gaurav nicely put this point around the voters' behavior and American people's behavior. So Trump seems to be playing to the gallery, and every time he tries to play to the gallery, the reaction happens somewhere else in the world. So it's nothing but playing to the gallery. But the bigger point here is, see, war situation or geopolitical situation is not new. When we look at past few years also, we have had situation with Russia and Ukraine, which has been continuing for last 3 years. We had situation with Israel and Middle East, and we have had situation with Iran and Israel also for some time. Some of these have become part of the daily life in geopolitics, and markets typically don't overreact to these news pieces anymore because they know that eventually a diplomatic solution will be found to some of these issues. Case in point was last year's India Pakistan escalation. For a few days it seemed like it can escalate into a full blown war, and markets reacted substantially to that. But within a week's time, a diplomatic solution was found, and peace was announced. So obviously, these news headlines attract a lot of attention, but real impact almost always doesn't last beyond a few days.
Understood. So investors should ideally take all of these news headlines with a pinch of salt and should not get too carried away with narratives, especially around geopolitical risk as of today, as we have seen from data in the past. Let's um, let's move to debt. Right, we keep hearing that debt levels have hit insane highs. Right, like this was on in economic times, right? Central government debt, balance sheets are beyond debt, world GDP still growing at 4%, right? So, Gaurav, I'll start with you. What do you make of a situation like this? What are your views on debt levels?
No, I mean, across the world, developed world, and in fact, even I think China should be here in terms of amongst those few countries right in the top in terms of central government debt to GDP, as Um, but this was clearly, in a scenario where, especially for the developed world, when the rates were much lower, and we are where we are today. Having said that, of course, we have seen rate cuts, continue. Uh, I think we have to look at again, if you leave aside a bit of the news flow which hits, but frankly, if you go back a couple of years, first, it was whether it was COVID, post-COVID. Then after that, as the Western world had taken on deficits and debt to kind of restart and keep their economies running, um, there was a fear that uh, uh, there would inflation could really spike up. Though the central bankers didn't quite believe it until it actually did spike up, and then uh, there was a huge spurt and a hurry to raise rates all the way above 5%. Then there's a fear that this would cause recessions and all that. And of course, then in the interim, there was the Russia-Ukraine war, huge disruption, much bigger, the biggest disruption of supply chains. Even I think it was more sharper, more severe than the tariff-related challenges of last year. But net, if you just reflect back, all each of these years at the start of every year, every calendar year, the fear of a recession and the fear that there will actually be some major slowdown as the year progressed was always the kind of running theme. And typically, as the year progressed, global growth has always held up in the last 3, 4 years, including the year which ended, where we had all these tariff challenges and fear on inflation, all that. And global growth is again going to be close to that 2.93% levels. And frankly, when we look at the projections, despite all the adverse news flow around, Trump and all the geopolitics, uh, I, even for 2026 and for the year after that, growth might just marginally take a dip, but be around that 3%, and then again, pick up further. So, for a host of reasons, we can kind of conjecture, but clearly there is more strength. Maybe it's just the interlinkages now are much bigger, and they've been created over the last couple of decades, in the global economy, such that all these headlines are kind of, while the headlines they scare, they cause that emotional, element, but the underlying sort of strength is still there, and that's been a positive surprise, frankly. Um so yeah, I mean, I'm making all this point that growth is there, and as we have seen, inflation has broadly now, at least on the goods side, globally come down to very low levels. On the services, it's a bit localized, but it's still coming down. In fact, so I would think that the US as well is still scope for rate cuts. then it's a uh, so we could be still looking at a slightly more benign interest rate environment, which would be supportive then of debt servicing and all that. Beyond that, it's to these for these respective countries to prudently manage their macros. I think in that front, while India is not here, India clearly has a lower central government debt to GDP. Would be, I think, within 70% or so, 75%. And we have a higher growth as well. Inflation under control, interest rates coming down. So it's clearly not a challenge for us in that sense. Yeah, the world in different pockets will have to figure and navigate their path for each of them. Just one point on geopolitics, since we covered it in the earlier slide. I just again want to just reiterate that there's a lot of headlines there, but we still have to keep in mind that uh, there is definitely a tension amongst big power blocks, and while countries' economies are all interlinked, and yet there's this pursuit of economic security, independence, especially post-COVID. The big countries have realized. So that whole journey is causing friction, and countries like the US and China are using all kinds of choke points to you know kind of bargain for better deals with countries which don't have that much leverage. Why I raise all this is that it's happening, and while global growth and Indian growth, despite all that, and despite the 50% tariff, is holding up, but we just have to keep that in mind. Somewhere there can always be unintended consequences. So as an example, Yash, to just conclude this point, if you remember the Ukraine war, the Western world just piled on to Russia, all kinds of sanctions and all kinds of confiscated the forex reserves. And yet, a year after that, the unintended consequences of the Russian economy had become much better. The forex reserves had gone up 4 times simply because of the impact on crude and all the flows they received from their crude exports.
Makes sense. Makes sense, Gaurav. Vaibhav, what do you think? Like, is should we just like not look at these headlines? How should we look at India's debt levels? And as Gaurav said, as percentage of GDP, we are well within range and much lower than some of the other top countries and economies. How would you read that?
No, absolutely. And we can't look at one single number in isolation. We need to look at numbers at each economy level, their inherent strength, their inflation levels, and stability of their currency. See, a lot of the current issue stems from the fact that US is sitting on large debt, and they don't want high interest rates because that will make servicing of their debt very difficult. Technology has been a big deflationary power over last 20, 30 years, and that hopefully will continue. There are consequences and unintended consequences of high debt, sometimes positive, sometimes negative. So if you remember in 2012, there was this entire concern around pigs. So Portugal, Italy, Spain, and Greece. All of these countries' economies are doing much better today because they took corrective action that time. And as a result of that, some of these companies are growing at very high pace and are looking much stronger compared to where they were. In India specifically, central government's debt to GDP is about 55%, and economists today praised Mr. Modi for the reformist attitude that he has maintained. He has been able to maintain despite all the world pressure, and which clearly tells you that India has managed its fiscal and monetary situation really well. We are sitting at 54-55% debt to GDP. Fiscal deficit is continuously coming down. So obviously that pressure is going down on the economy. And our inflation has been benign, so which allows India to operate at an interest rate which is much lower compared to the other parts of the world. One thing that we tend to miss is if the cost of capital keeps coming down, it creates a lot of opportunities and wealth for everyone. Some of the events which are playing out in the world is great for wealth creation in India. Last year, Indians created a wealth of $1.5 trillion purely because of the gold holdings that we have. total gold holding of Indian households is almost $5 trillion now, so which is equal to or more than our current GDP. So obviously, some of these things have to be analyzed comprehensively instead of looking at one headline and saying this has become so, therefore this will be the consequence. The consequence change depending on the context in which these events are playing out.
Thank you. We'll actually come to gold. We've got already a lot of questions from the audience on gold, and we'll take them up towards the end during the Q&A section. Um, So let's come back to one more headline which came in January, 8th of January, which says Trump okays a 500% tariff bill on Russian oil, right? And Weber, we'll start with you for this one. However, there are some exceptions to this, right? And those exceptions actually make it way more resilient than the headline number of 500%. So what do you think is happening here? And how should investors in India look at some of these exemptions and counter the 500% tariff bill?
See, tariff is limited to a few industry, and it's going to impact those few industries in a meaningful way. But government has come out and supported those industries. So textile, gems and jewelries are a couple of industries which will get heavily impacted. Large sectors like healthcare, metals, automotive are excluded from the purview of tariffs. So India's trade to US is about export to US is about $100 billion annually, and half of that is exempt. So the impact is limited to 40-50 billion dollars worth of exports. So I don't think we should worry too much about it. A lot of Indian entrepreneurs are also smart. They are able to divert their supply to other countries, and those countries in turn are exporting to the US. So I was speaking to a couple of entrepreneurs, and they said a lot of other countries have come up and asked for our products. So there is no slowdown per se on account of tariffs. There is a diversion of trade which is happening through other countries. So if you look at this data on the right hand side, you will see that annually there has been a growth in total exports to world. Even though we have seen a decline to in exports to US as a percentage of total exports, but overall India has seen export growth, which clearly means that entrepreneurs are finding their way around this issue, and the impact is limited to a very few industries.
Gaurav, just continuing on Weber's point, do you see alternative markets today for these goods? Why do you think is this change on a month-on-month level? How are we increasing if the exports to US is decreasing?
Okay, so what's happening is that of course, are geographies which have lower tax incidence with the US. So there is, some rerouting happening through such geographies. That's to be expected. See, the world is, as I was saying earlier, the world is very interlinked economically. So we have seen whether it was Ukraine war, things get rerouted, and I suspect that is happening. But additionally, from India's point of view, frankly, while we've had one or two, kind of trade deals with, say UK or New Zealand, or Oman, but the bigger ones, leaving aside US itself, but even with the EU or maybe the Latin bloc, if those were to happen, then they'll help a lot more to mitigate. And yeah, I mean, um, so what's happening? Not surprising, but nothing like getting more deals in place to kind of mitigate this impact. We don't know when it gets sorted versus the US, and yet with the US also, that frankly they'll be. We still have to be watchful that some things, maybe some bits of gems, jewelries, or the fisheries and all of that has gotten rerouted. There could be some parts with textile, something where the hit is still there. And mind you, what's happened right now with these current tariffs, India versus neighboring geographies, whether it's South Asia, Southeast Asian countries, which are often competing in some of those labor intensive products, it does put India at a disadvantage. And then there can be the second order impact of labor, unemployment, and credit and all that. So government, as mentioned, is putting in focused measures to help with credit guarantee and all of that. But yeah, so that's where we are. We have to just take it. Frankly, if we step back, last year, the first time this was announced, the sense was that this will not last more than a few months. But here we are, and it's in fact gotten ratcheted up as far as India is concerned. But again, entrepreneurs and economic linkages being such that there's been reasonable dynamism to kind of spread out the pain. But I think we still have more ground to cover, especially FTAs with other big blocks should help. And then even in terms of exemptions, the last point that when we speak to companies bottom up basis in in area, because right now there's a 50% tariff. Now, what if you're a chemical company exporting to the US? So companies are facing that challenge. Now, it might be 5-10% of their turnover, but frankly, the impact through margins is much more. And so the stock market realizes that. So when we know those bottom up companies, we speak to the man, we realize that there's a whole part of the market which is now under pain because of this element. 5, 10, 15% of their turnover and profits is hit. And so therefore profit growth is hit, and the market is therefore, accorded them a nice correction. Conversely, if this thing were to reverse, then you could see a pop-up. So I'm just saying bottom up, there are, firms across chemicals, maybe some other in the engineering industries, etc., where they're paying that duty. Now, here also, when we speak to companies, the good thing is that a lot of the products which India makes for the US markets, there's a fair amount of inelasticity, in the sense that there are not too many alternate suppliers, except maybe from China. So there, and that's the funny thing. The data is suggesting that even now, 80% plus of the tariff is being absorbed by end US customer or the end US importer. It's just the remaining, 10 to 15% maybe, which is taken where the hit is taken by the exporter. So yeah, and that's where we saw that last time Trump, the political outcomes became unfavorable. I think those, and so he had to reverse some of the tariffs on items which were pinching the common man there. So yeah, it's a kind of a fluid situation. Uh, I would say that yes, some of the pain is mitigated, but I would rather that it's all mitigated.
No, makes a lot of sense as long as we, as a country, I mean, if there are only two suppliers of certain materials, one of them China, one of them India, I mean, you will have to get those products and those raw materials. Moving on to currency, right? Headlines: rupee hits another low, right? Slumps to 90.43. It was 91, I think, last week, crossed 91. Vaibhav, I'll start with you again. Rupee has been depreciating against the dollar, right? And it has, like, we've seen so much of this depreciation over the last 2 decades. What do you think? Why do you think that's happening? What do you think is the second order effect of this? Do you see it bouncing back? And if not, then how can we make the most of this situation?
So I think rupee depreciation at a steady pace is not such a bad thing. It cushions some of the blow that we receive from tariff. Also, it makes us competitive compared to other countries in our ability to export material. Having said that, the recent correction is largely driven by liquidity outflow, which is a result of a lot of IPOs raising money and funds taking out that money, funds or promoters taking out that money out of India. So, for example, LG came out with an IPO, so that resulted into FDI outflows. So, some of these examples are there. On an average, rupee has depreciated at 3.7% per annum. So, on the balance, on one hand, if the rupee weakens, then we import or run a risk of importing inflation. And if rupee remains too strong, then we lose out on our ability to be competitive on export front. So it's a tight rope. 3 to 3.5% depreciation in rupee is not a bad thing. In 1985, we saw a similar situation where US was unhappy with Japan and said your currency is way too weak and it's leading to large trade deficit with US. And Japan agreed to uh, appreciate their currency, and US dollar was devalued against Japan. And consequence of that was a lot of export oriented industries in Japan were killed because of that. So you don't want a situation where you let your exporters suffer because you want to show good headlines. 3.5, 4% is a good depreciation in rupee. It keeps us competitive, allows us to generate higher earnings compared to being in a neutral currency environment. In fact, most of the people don't appreciate the fact that currency depreciation is accretive at the index level. So it's not such a bad thing as long as it is controlled, it's gradual. I don't think there's too much to read in this. It's been a trend. Rupee has continuously depreciated over last 21 years. As you can see in this chart, 16 out of 21 years we have seen depreciation. So beyond a point, these numbers are just psychological levels and not relevant for the purpose of regulators or investors.
Sorry, Gaurav. They say that when the rupee is depreciating and we should make the most of exports, right? India needs to increases exports to make the most of this rupee depreciation. In your conversations with, say, company promoters or stuff like that, are they talking about levers that they will use to increase the exports, make the most of this rupee depreciation, or do you have any other view on this?
No, I mean, first of all, clearly this has probably been led or encouraged, the rupee to depreciation because we are at a disadvantage versus other uh, countries in the neighborhood, whether South Asia, Southeast Asia, who are competing exporters, especially in low margin, those low value, high volume products in the textiles and all of that segment. Um, so those are very finely, sort of uh, priced. And I think just to give that, sort of a buffer to the Indian exporters versus them. But see, if we are talking about exporting from other industries, exporters from other industries, whether it's pharma or other high-end specialty chemicals, this is not such a relevant factor. There are other entry barriers which these firms encounter. Um, and where this is not at all significant either way for them. Maybe it can give a small fill up in near term margins, then depending on what are the contracts, some of it can be clawed back, etc. So I don't think this is too much of factor to boost exports for segments where there is another reason why that export was happening in the first place. If an engineering company was supplying some capital goods, transformers, to the parent or some bearings, etc. Then those are, decisions where the plants and the agreements are put in place with a very medium long term. Similarly, with pharma or chemicals, their niche. If it was completely a mass, then probably a mass produced low value item. It would have probably been imported from China. Here it's just a couple of notches up from India as far as a lot of the uh, corporates we deal with are concerned. But yes, at the lower end, it's just fine priced, low margin textiles and all, where there's a lot of labor stakes involved. Then for them, I'm sure some of this might just give some armor versus the higher tariffs on India right now. And having said that, again, I'm I'll just kind of reinforce this point that it's not a concern really beyond this, depreciation recent times because Indian macros are very stable. They've been stress tested in the last 2 3 years. During COVID, during Ukraine, but they've all held up well on whether it's the growth. We still growth's been just inched up as we speak for this year, and I'm not sure. I'll not be surprised if the market is underestimating the growth outlook for next year as well for India. Whether it's control of the deficits, the fiscal, the current account, and the inflation itself, and therefore the interest rate regime, which is has turned very accommodative in the recent times. And so, typically, if exchange rates are looked at on basis of differential in the inflation domestic versus the home market, say US. India is in a good wicket, and on growth as well, where again we are. So there's nothing too fundamental suggesting that the rupee has to weaken. Where there's a banana economy here. No, not at all. It's the converse. It's a very strong, robust macro economy which is facing this global headwind of tariff. And as I'll repeat again, that we've been singled out with that 50%, and yet we're kind of holding up pretty well.
That's fantastic, Gaurav. That's just the right kind of optimism we need going into 2026, right? Um, I'm going to focus on flows next, right? Again, headlines are FIIs have been pulling out. In fact, on 27 December, Times of India said that FIIs are set for the biggest exit from Indian equities, right? And we have all sorts of counter data to it, right? Domestic flows are holding up. Mutual funds and SIPs and domestic mutual fund participation is at an all-time high. We can see almost like 77,000 crores in 2025. What Gaurav are you making of this, right? How do we balance out the FIS outflow? Do you think they will increase in 2026? And will these headlines continue?
Uh, yes, I mean, this is anybody's guess, but frankly, if you go back to the period of 2023, also first half of calendar year 2023, there was huge outflows. I recollect FI holding at that time had also come to close to, and in absolute amount, the outflow was equal to what had happened during the GFC. And FI holdings in Indian equities had started, tapering quite significantly. But frankly, what's happened in the last few quarters has worsened. So now clearly FI holdings are at the lowest level. Since they've entered Indian market, since over a decade and a half at least. And similarly, or rather, let me put it, their outflows this year, the year ended 2025, have been the highest since they've ever entered the Indian markets. And holdings, their FI holdings in India of Indian equities also come to, I think it's a 15-year low now. So that's where we are. But will it, to what is causing this? First of all, let me just step back and just make a point that it just reflects the health of the Indian markets. That that Indian capital markets are in a very very fine health, because the markets might have given a whatever, the large cap might have given a 10% return, the mid cap lesser 5-6, and small cap maybe negative 5-7-8. I'm talking about the year gone by, maybe plus minus a little bit more minus. But frankly, this is despite such diverse behavior. So one set was buying, one set was heavily selling. So it's not a one-sided market where everybody's a seller or everybody's a buyer. That's a bad, because that's where then you can have much stronger volatility, especially if you're in a very peakish or euphoric range. So in that sense, it's a healthy market where valuations are also at broadly average, maybe plus minus, but nothing to worry about. And therefore, the setting is for an investor. It's a good setting if you're looking at allocating towards equity with a slightly, at least a medium term, 3 years kind of thing. Short term, we don't know how the markets could behave. Now, that's how I'm thinking of it really. I'm happy that this has happened. I'm happy that the FIIs and the stakeholders have taken money on their investments. So they've seen profits. Now, it just shows that they've seen profits. India is a good investment destination for FDI. And therefore, at some stage, that money, when it looks around for opportunities, should be relooking at India to reinvest, in newer projects, newer companies, and so on. So in that sense, that's the and then of course the IPOs happened again. That's they're doing the part. The capital markets are doing the part of helping firms raise resources for growth capital in otherwise what was considered to be a capital starved economy. So that's the background. So this is just the kind of the number is this. Now why is it going out? We know there's an AI trade happening. You're a fund long only manager sitting anywhere in the world. The returns already made, but you don't want to miss out on more. So you're kind of selling from liquid markets where maybe over a longer period you made some money and you want to capture that, you want to participate in that AI trade. That's what's happening. It can happen and for some time longer maybe till something gives or breaks there. Though I mean, yes, it could continue for reasonable periods. I'm not calling out that it's stopping tomorrow or in 3 months. That's a separate, trend which is underway. I think that's broadly it. But yeah, I mean, at some stage, valuations, time correction, have a part to play. And frankly, lastly, I'll say that also, earnings for Indian markets. So post COVID, at COVID, there was a sense that earnings will get cut. But frankly, that year onwards, earnings surprised on the positive, and they kept on surprising for 3 years. So corporate profits with GDP, which had hit their lows in 2019-20, then have come back to their average levels by 2025 beginning. Corporate profit to GDP ratio. Now from here on, then it's got to be the growth of overall, nominal GDP and at least corporate profits, which will determine the kind of flows and the outlook for Indian market. So, unfortunately, last calendar year, for the first half, for a host of reasons, the earnings got cut as the year progressed. So, I think if FY25 we saw for the large, markets of 5-6% earnings for the large 100 stocks. This year also it's come to within 9-10% range. But this is now looking better because a lot of it is in the base. For instance, banking is a big part of the index profit pool, and there were rate cuts, so that has had a temporary pressure on margins for a couple of quarters. But now that will reverse into next financial year, and at least as we see projections right now, earnings growth is expected to be in the double digit range. Let's see where it kind of moves up, but 12 to 15. So that could be the reason that for flows to come in, that comfort and confidence of earnings growth for India getting back into the double, digit trajectory. Then that, versus what we just saw transpire in the last few quarters, where it had slipped into single digit, and then you had other markets with cheaper valuations, AI also there, and so that kind of would have played out for global equity allocators.
Got it. Vaibhav, the same question to you. We've seen that whenever the INR has depreciated, it has been followed by high FII flows, right? We can see that in 2022, depreciated by 10%. Next year, FII flow was about 176,000 crores. So in 2025, we've again seen the rupee depreciate. Does that give a sign, going purely by historical data, that there is a possibility for FIIs returning? What's your view here?
See, it has to work in combination with the relative attractiveness of Indian equity markets. So, if Indian equity markets, because they deliver superior earning growth and are valued much more attractively compared to other markets, then FIs will definitely return. Most of the money, equity market money over last few years has got invested in US markets. Every large institutional investor has put their equity money in US markets, and they benefited also. Obviously, India also suffered because of that. Everyone wanted to invest in AI trade and wanted to liquidate the portfolio where profitability was there and liquidity was there. India provided liquidity because we had large domestic inflows supporting markets. As you can see, last year, uh, domestic flows were almost 5 times of what FIs pulled out from the market. So that gave cushion to the market and also gave liquidity to the FIs, and which has ensured that they are able to liquidate money comfortably. Now we are getting into a situation where AI valuations are much higher compared to the justified levels, and Indian market is relatively getting more and more attractive. And with the rupee also reaching attractive levels, when you look at real effective exchange rate, we are reaching attractive levels. That should possibly put this thought in FI's minds that India relatively is much better place. Timing of this obviously nobody can predict, but when I look at the fundamentals, there is no reason for which FI should withdraw money and not invest money in India. And if the momentum of both FI buying and domestic buying happens together, then as Gaurav said, markets can experience very high valuation and high volatility.
Got it. Makes sense. Um, one of the last headlines I want to focus on, and I also want to keep do the time check, because we want to make sure that we have enough time for Q&A, right? So AI is pushing record job cuts, right? And from the data we see, I mean, the headline largely focuses on one company, which is TCS. saying that the net addition in jobs is actually negative. But we see all the other IT companies have actually added jobs, right? So while one company is used to drive the narrative that AI is pushing record job cuts, it's not actually the situation when you look at the whole industry. Vaibhav, what do you think? How should we read these headlines, and what do you think is the future outlook for at least job cuts driven by AI?
So obviously it's an issue which needs to be addressed. There are job cuts and there are real job cuts, but degree of that can be debated. And second thing which is happening is salary levels in India have also gone up parallelly. So both of these are happening together. So again, as I said, looking at headline without the context can be extremely dangerous. There are other jobs which are getting created, which are as rewarding as some of these IT jobs are. So IT uh, employs about 1% of India's working population and contributes to 6% of India's GDP. Obviously, there are concerns when 6% of your GDP looks vulnerable, but there are other industries which are becoming as big or bigger than IT, where compensation levels are extremely attractive. New avenues of growth is GCC. GCC clearly is a big change for India. A lot of new large campuses are getting set up in India, and which should offset some of the job losses which are happening in IT. There are new industries like our industry or asset management companies which are recruiting aggressively, and there again, salary levels are very attractive, and hopefully some of that cushion will be given by our industry also. Having said that, we can't be blind to this fact, and it can impact some of the sectors like consumer discretionary and consumer staple adversely if this continues without the compensatory effect of other industries.
Listen, Gaurav, do you have a view on this? Gaurav, you're still on mute. Um, Gaurav?
Oh, you're on mute, Gaurav.
Sorry about that. No, no, this headline, like the other headlines, was also, sensationalizing the issue. TCS, I suspect every year has, any firm might have, the bottom, a percent or so which is let go. In this case, it was just slightly more, maybe instead of one, maybe two, and that was it. I think it was more restructuring, and the headlines might have read that it's AI driven. I don't think that was the case. Each of these firms is completely reskilling staff to be AI enabled and to to leverage AI for enhancing productivity and delivering superior outcomes for customers. So my view is that I mean I don't see job losses on this count, at least as far as the software sector is concerned. In fact, I see that there could be a period where as firms adopt and improve on their offerings for their end customers, which we are in right now, then hopefully there's more business which comes to help end customers, end corporates in the Western world, Europe and US, to implement enterprise-wide AI and all. And I think Indian software could have a place there. Maybe there is some element of pricing give and take and margin pressure, but over periods of time, typically technologies lead to superior outcomes. So that's my view. I'm constructive, and of course, this GCC phenomena is like is happening every day. We see headlines, right? There's lots more employment happening there. In fact, Bangalore is clearly in the forefront of things, and so therefore, as far as employment, at least in the urban pool, is concerned, I think that's as robust. One half of the employment pool in the urban economy is central and state government employees. Those are secure jobs, and any the other, I would not be concerned.
Got it. Vaibhav, I want to make sure we cover some of the other stuff slightly quickly. Volatility is a feature, not a bug, right? There is always going to be a reason to get out of equities, get out of pull out money. And we've seen bunch of different things play out from time to time, right? How should one look at volatility, right? If you could give me a lens to look at volatility, what makes wealth erosion, very difficult if you follow certain things.
So obviously volatility is a feature of equity markets. If returns were linear without any volatility or without any drops in the interim, then equity would also behave like fixed income and deliver returns also like fixed income. Because we are expecting equity to deliver returns higher than fixed income, we have to deal with the volatility. Over last 30, 35 years, we've seen multiple events and markets have always bounced back from those events and have resumed its upward journey. In my personal career also, 2003 is when I started. Uh, a new mean could never comprehend the fact that markets can have lower circuit of 20% when the government changes. But in that year also, in 2004, when NDA government lost the election, markets went down by 20% in a day, but they ended the year positively. So interim volatility is a integral part of this process because market is hypersensitive to any headline which can impact future earning potential of the market. But markets eventually internalize and comes to a point where it rationally uh, analyzes all these events and takes the path which is right for the markets based on the earning growth. So there is a feature. One thing that most of the investors miss out is to take advantage of the crisis. Ask any investor who invested at the peak of global financial crisis, during COVID crisis, the amount of money that they made is immense. In a normal course of market, you don't get these kind of opportunities. But when you get these kind of opportunities, you need to double down. And your returns obviously will go up significantly if you are able to capitalize on these volatile and scenarios. So as they say, crisis creates opportunity in markets also. Crisis always creates an opportunity. Volatility, sharp corrections which are unjustified will always lead to sharp rebound and very high returns for the investors who are investing at those levels. Now, obviously, not every event will impact the earning potential of the market. So you don't have to react to each and every event. So we saw that in 2024 when Trump, 2025, when Trump announced additional tariff on India, obviously markets absorbed and moved on. When there was India-Pakistan crisis, that time again markets corrected a bit, analyzed the situation and resumed its upward journey. So what we need to analyze is something which is changing the fundamental structure of the market. Unless the fundamental structure and earning potential of the market is not changing, then we don't need to react to those events and rather capitalize on those events which are unjustified. What we have done, so as you can see on this chart, almost there were 12 events, one every month. Only three were relevant to us, and we reacted to these three. The rest of all were headlines without any substance. So all of these events created opportunities, and we reacted appropriately. Now, obviously, this journey is not smooth. What you can do to smoothen your journey is to follow a strict asset allocation model. As you can see on this chart, every year, different asset class delivers superior returns. 25, 26 continues to be precious metal year. 24 was S&P 500, 23 was small caps in India, 22 again was gold, 2021 was small cap index in India. So every year we'll see a different winner emerging out. Very difficult to chase the winners based on the past performance. The best way is to define an asset allocation and make sure that you never hit the bottom. The cost of not hitting the bottom is that you will rarely hit the top. But that should be okay because the risk of hitting the bottom is much higher compared to the payoff of getting to the top. So that's how I think investors should think about investing. Asset allocation is extremely, extremely critical and important part of investing. If you are able to get your asset allocation right, you'll be able to stay invested for a long period of time and realize the returns. If you invest in volatile assets, more often than not, you will end up liquidating your position as a reaction to the volatility. I have a crazy client story in 2020. I had two clients. One was selling at the bottom of the COVID crisis, and other was buying at the bottom of the COVID crisis. And all of us know what the outcome has been after 5 years. So crisis always creates opportunity, but at the same time, it's important that you buy the ability to stay invested in the market.
Makes a lot of sense. Web of sticking to asset allocation, helping weather some of that volatility, provide some cushion, and most importantly, optimize for capital protection as well as capital growth. Right? I think asset allocation does a great balance of that, and I really hope that that's the one of the most key things that the audience on the call takes away today. Do you want to take a minute, Webhav, to speak on the different strategies that we have at Deserve that allows investors to do asset allocation?
Absolutely. So we typically divide our portfolio in three categories. Set of assets which deliver growth to the investors, where you will have equity strategies. We have three strategies. Equity Revival is a multi-cap strategy. Alpha Focus is a more mid and small cap strategy. And Deserve Constellation Fund is an alternative investment fund which gives you access to boutique fund managers who are doing bottom-up stock picking. Then there is a bucket which gives you protection, where we look at returns which are stable without any capital risk coming from fixed income. We run strategies like Deserve Dynamic Debt and Stability Reserve and Arbitrage strategies. Objective is to deliver high post-tax returns to the investors in a secured and liquid manner. Last category is for diversification, where you invest some money in real assets, hard assets like gold and silver, and also look at some REITs and InvITs. So these are the strategies, and each investor's portfolio should have different allocation to these strategies depending on their requirement, and they should have a conversation with their relationship manager to find out what is the right allocation for them and what is the right strategy to invest in.
Got it. Thank you so much, folks. I'm going to open it up for Q&A, but just before that, we always say that the best time to review your portfolio was yesterday, and the second best time is right now. So if you think that some of the narratives that we discussed in the beginning of the presentation has kind of creeped into your investment decision behavior, and if you would like to get a deep review of your portfolio, you can log into the Deserve app. You can scan the QR code, and you can set up a meeting and book a call with one of the Deserve client financial experts, and we can do a deep analysis of your portfolio. No commitment required at all for this, and so please do take a look at that. I'm going to open it up for Q&A. We'll try to Web of Gaurav will try to keep it super articulate and super direct and quick. Right, there are like 40-50 questions. We're going to try and get as many. I'm going to club it together. A lot of the questions around gold and silver. Do you think that the rates are going to settle down, and how should they think about the allocation to precious metals, specifically gold and silver? Gaurav, why don't you go first?
Oh, okay. Okay, from the equity guy. Okay, I thought you were going to ask. No. I think that there should be. There's always a need for uh, adequate asset allocation, and therefore these precious metals do fit in that. Now, whether that range, it's very client specific and his risk profile, etc. But anywhere between at least 5 to 15, I would say, top of mind. And yes, having said that, if one is has been a bit underexposed, just my sense that given the sharp, kind of vertical moves we have seen, especially in silver, I would personally have thought that it's just time, better to just wait for some correction and then invest. But yes, all of them will remain relevant. One, silver, because while it's all kind of moving together, but silver because there's also the additional industrial applications across a lot of new age applications, EV and semicon, all that stuff. So that will create that demand. And in the case of gold, I mean, at least given the this geopolitical environment we are in, and I clearly see that continuing for at least another few years, and it could be well longer. where there's uncertainty on wars, on politics, on trade, on economics. So an asset like gold will have reasons to, if not in one line in linearly, but at least kind of trend upwards. So I would think yes, the need is there to be present in one's portfolio for both these precious metals.
Got it. So I'll just summarize it. Silver still has a potential because its demand is largely coming from industrial use, right? So usage of silver in different industries. And gold because Gaurav foresees that the geopolitical environment could continue, and therefore gold is always a fantastic allocation to that. Weber, I'm just going to ask you one thing. Do you recommend a percentage of portfolio that should be allocated to gold and silver? We know that it's going to be prevalent. Is there a
10,
percentage you would say?
10% is the number that we think investors should have to precious metal.
Okay.
Right, we are not investing in silver. That entire 10% is going to gold through our Shine strategy, in which we dynamically manage allocation between gold and silver. Currently, we are invested 100% in gold there.
Makes sense. Mr. Anil has asked, Revan, this is for you. How often does an investor have to rebalance their portfolio?
Once annually, it's very important to rebalance your portfolio. See, there are two, three things which happen. Some of the stocks or securities that you are holding may become irrelevant in a given, or may not be the most attractive in a given operating environment. So I'll give you an example. I received a notification from Money Control yesterday. DLF hits 52-week low and Hindustan Zinc hits 52-week high. 2 years back, the notification was completely opposite. Hindustan Zinc was at 52-week low and DLF was at 52-week high. So these cyclical changes in security levels need to be evaluated, because you are seeing pockets of the portfolio which are getting overvalued and pockets of the portfolio where undervaluation is there. So this is important that you realign your portfolio for the operating environment in the economy which is there. Second, asset allocation review should be done, which ensures that any asset class where you are getting overexposed, you should cut your exposure and bring it back to the strategic levels. So, for example, investors who would have invested money in gold and silver, if their strategic allocation was 10%, and because of high growth, if the number has gone to 20%, it won't be a bad idea to bring it down to 10%.
So that actually leads me to there's a bunch of people who are asking what should be the asset allocation for 2026 in percentage terms. You've already said that gold and silver should be at 10%. How would you view equities and fixed income in that asset allocation percentages?
Oh, for 1 year asset allocation decision is difficult. I can just say that equity should, by end of the year, should deliver 12% kind of returns sitting from where we are. Fixed income will deliver 8 to 10% returns pre-tax. Equity should deliver higher post-tax returns, and precious metal should also deliver positive returns. What you need to find is the right ratio across three asset classes, basis your ability to manage volatility, your liquidity requirement, and time horizon. The
Uh,
issue with investing is it's not a point-to-point observation uh, subject. So if you invest today and analyze after 1 month, the outcome can be very different compared to what you would have thought or what we would visualize. When we are recommending these asset allocations, we are taking into consideration macro factors and time horizon for which investor will be investing money.
Gaurav, given your bullish stance on the equity markets, someone has asked which sectors do you think would significantly outperform?
I have a constructive stance on equities, and I think it becomes bullish for investors with a slightly longer horizon because when we're talking 3 years plus, because then the power of compounding also starts working relative to some of the other asset classes. But yes, and then uh, for in terms of what sectors, see, we are in a. I'll just give a background that we're in a situation where there lots of government support which has been put in place, and yet we have to see how this unfolds in this year, in the current year. So I think this is going to be a year more of bottom up ideation, frankly. But yes, amongst the bigger sectors on a top down basis, the banking financials, the private banks, for instance, I think should have a good year this year coming from where they have been. Of course, there's been a bit of re-rating catch-up already, but I think now we'll start seeing earnings-led growth happen for that cohort, maybe with some element of re-rating. And of course, asset quality remains comfortable. So, and valuations are also. So, I think that could be one big set. Then smaller would be, a little bit more sort of, bottom up consumption. We have seen the auto part already do well with all the government support. There could be others which get a leg up in the months and quarters ahead. There could be even bottom up, ideas in select areas of capital goods and infrastructure spending, not necessarily related to budget, but because of other trends which are underway, whether in transmission distribution or whether the capex happening in select cohorts of data centers and some of private capex happening. So again, bottom up. Consumption also, I said, beyond auto, other discretionary where there is a sign of strong revival.
Understood. There are a couple of questions on SIFs. Vaibhav, do you have a strong opinion on SIFs in a volatile market to get some advantage, as SIFs are long short kind of a
See,
instrument?
it's part of the asset allocation that you will make, and it leans more towards fixed income than equity, because most of the strategies which are currently available are running it as long short fund with the tax advantage of equity. We will eventually have funds which will go purely short on the market and try and generate absolute returns. But as of now, we don't have these funds in the market. So, as part of your overall portfolio, SIs will have a role in reducing volatility in the portfolio and may become a substitute to your fixed income allocation.
Makes sense. Folks, we are already about 3 minutes over the stipulated time. We will try and we'll try to put all the questions together and maybe create a note which answers a bunch of them and circulate it very soon. But thank you so much, Gaurav, for taking out the time, speaking to our audience and attendees. Vaibhav, thank you for doing this. Hopefully, it has been a very insight-rich experience for the attendees. And folks, thank you for joining us this Saturday. We will see you in the next webinar by Deserve.
Bye, everyone. Have a good day.
Bye, everyone. Thanks for joining.